I'm Dr. Baldwin, and this is a demonstration for Chapter 3. We're going to demonstrate adjusting journal entries here. If you have worked this problem already, then carry on. If you haven't, then you need to close the video, look at the link just above the video in Blackboard, click that link, download the PDF, and work the problem first. Your learning is going to be unbelievably enhanced if you work the problem first before you watch me work the problem. Yes, even if you work it incorrectly, you're going to be better off. So, assuming you have already worked the problem, let's see how what you've done compares to what I'm going to do here. So we're looking at year-end adjusting entries. So let's assume a calendar year. So this is going to be 12/31 at the end of a particular year for this company. And we're going to make the adjusting journal entries. Why do we need to make adjusting journal entries? We need to make adjusting journal entries because some events have happened that haven't yet been recorded. So, for example, we have incurred interest costs, and we need to recognize that expense. Even though we're not going to pay it until after the beginning of the year, we've already incurred it in this year. So that expense needs to be matched into this year. There's similar with, say, wages expense. The workers have worked, we owe them the money, but they're not going to be paid until the first Friday in January or something like that. It could have been revenue. We could have done some work and we haven't recorded that revenue yet. We need to record the revenue and, bill the customer that hasn't paid us yet. Or we may have used up our office supplies and we need to record that those assets no longer exist. They've been used up and they have become an expense. So there's lots and lots of examples there. By and large, they all have to do with the matching principle. Matching expense to the revenue or to the period, recognizing revenue in the period in which it has been earned. So let's read these and work them. Wages accrued but unpaid as of December 31 amounted to $10,000. This is part A. Normally we'd have a date on it. I didn't put dates on these, but you can imagine that A is a date. So we'll put our date in there. And normally if you were recording this, an accounting paper, you'd have columns and whatnot. You just write it neatly and you don't have to worry about drawing the columns. So we have some wages that we know we're going to have to pay maybe on January 2, whenever the next payday is, but they've already done the work. So we need to recognize that. We need to recognize that wages expense. So our debit is going to be to wages expense. That's an expense account. Expenses are normally debited to increase them. We don't normally decrease them unless they're wiping them out for some reason. So they have a normal balance of a debit. So I'm going to put my $10,000 over here in the debit column. Remember, debit just means left. It's the left-hand column. We're recognizing the fact that they've earned this money. Therefore, we're recognizing the fact that we as a company owe them the money. So we're going to recognize a credit to a liability called wages payable. Now, it's a liability. It's on the right-hand side of the accounting equation, so it's normally increased by crediting it. Credit just means the right-hand column. In Part B, it says, the company's bank loan has accrued interest in 2013 of $200 that will be paid in 2014, so next year. But we've incurred the interest, we need to recognize the expense, and we owe the money, so we need to recognize the payable. So this one is, in theory, sort of similar to Part A. So we've got B here, since we don't have a date, and we have interest expense that we're incurring, or have incurred, I should say, of $200. And we're going to recognize that interest is something we owe, so we're going to recognize a liability called interest payable. And a normal balance for a liability is a credit, so that makes sense. Normal balance for an expense is a debit, so that's pretty standard. A and B very similar here. Let's look at C. The company received $5,000 advance payment on December 1 for services to be rendered. So they paid us on December 1 for something that we're going to do apparently during December, and we did it during December. As of December 31, 80% of the services had been rendered. So we've earned 80% of that money now. So we can put C here, or we can put the date. We know the date's 12/31. We put what happened. We earned some revenue. Revenues normally have a credit balance, so there's our credit. And we're going to recognize, right, that they gave us the payment in advance, and now instead of being a liability where we need to do the work, what we have here is a reduction in that liability. So presumably on the first, they gave us $5,000. We debited cash because they gave us cash, right? And we credited what? We credited unearned service revenue or unearned revenue of some kind. I'm going to call it service revenue. So now we need to debit it to get it out of unearned service revenue. That's actually a liability account despite the fact that it has the word revenue in it. And credit service revenue to recognize the revenue. So I'm going to debit unearned service revenue, whatever we called it back on December 1. If we were making lots of journal entries here, we'd go back and look, all right, if we didn't know. And then we're going to credit service revenue. For how much? It says we've done 80% of that $5,000 worth of work, so 80% of 5,000 is 4,000. 80% times 5,000. I'm going to show you math here, which is always a good idea. Letter D, we've got the beginning balance of office supplies was $2,000. During the year, 1,000 of those additional supplies were purchased. At the end of the year, $700 of supplies were on hand. So we have to figure out how much did we use up. Well, let's think about the math here. So at the beginning of the year, we had $2,000 worth. At some point during the year, we purchased another $1,000 worth. So we had $3,000. We could have used up as much as $3,000. But it says we have $700 left. So this is what's left. That means we must have used up $2,300 in the given year. Okay? So basically that tells us our journal entry is going to be for $2,300. And we have to think through what account we need to debit and what account we need to credit. Well, what are we doing? We have $3,000 in office supplies here on the books. That's an asset. But guess what? We don't have that asset anymore. We have only $700 left. So we need to reduce that asset and recognize the expense. So we're going to debit office supplies expense. And we're going to credit the asset office supplies. Assets normally have a debit balance. We're decreasing it here so it gets a credit. That's your adjusting entry. We make these entries at the end of the year, the end of the fiscal year. We'll use a lot of examples where it's 12/31, which it normally is. The end of the fiscal year, because we want to match expenses and revenues to the appropriate period. We want to recognize them in the period in which they've been incurred, if they're expenses, or earned if they're revenues. Okay, get some practice doing year-end adjusting journal entries. You're going to need to do that.